Good afternoon. This is Xavier with Daley and Paulk, and today we're just going to be going over the markets. We're going to have a weekly market update, looking at the dollar, looking at yields, crypto, oil, some macroeconomic indicators as well, and why I think the theme and the story for this week is the Fed. It looks like they're doing quiet quantitative easing, meaning the government prints money for our government or our central bank to go ahead and buy our own assets. We're buying our own treasuries. Uh, and we're just going to be taking a look at some data and let's dive right on in. So first, we're going to be looking at the dollar. The dollar is slightly higher for the week. Ever since 2024, it's been going down, which has actually been a really good thing for the metals because the metals are priced in dollars and dollars have been going down. So I'm just gonna write something up for you real quick. Let's say there's X and then there's dollars. Okay. Well, if the dollar goes down, the value and then the value of X like stays the same. Okay. This is going to equate into a higher absolute term for the entire equation. Because the denominator went down and the numerator stayed the same, the entire price, the price of said asset is going to go up. So if the dollar goes up, let's say you have an asset and the price of the dollar goes up, the price of the total asset is actually going to be lower in nominal dollar denominated terms. Okay, does that make sense? So if the dollar goes up too strong, it can actually break. It breaks assets and it causes deflation because the denominator, the currency, is going up too fast. Now, is the dollar going becoming too strong too fast right now? Absolutely not. But this is just a reference and a guide to show you a little bit about like how the markets work. Okay, so the dollar's been going down. I think the dollar's going to go down a lot longer, a lot faster. But for the last week, it has been going up. Next thing we're going to look at is yields. So we talked about how bond yields and how bond prices are inversely correlated. And recently, we had a 2% decrease in yields. So up right here, I think you guys actually can't see it. This is the U.S. government bonds 10-year yield. Maybe I can. 1 second. Oops. Okay, I'm actually not going to touch anything. But yields going down means bond prices are actually going up. And yields are the cost of money. So that means money is becoming more abundant and money is becoming cheaper. So kind of to illustrate this idea again, let's say there's bond yields and there's also the price of the bond. Bond prices. If the bond yields go down, bond prices consequently go up. And also, let's say people are selling a bunch of bonds, which causes the price of bonds to go down. The yield must concurrently go up as well. So that is how the bond market works and how interest rates works. So with yields going down, we should expect bond prices to go up. And if yields went up, we would expect bond prices to go down. All right. Therefore, looking at the bond market, bond prices are actually up 1.61%. So we are actually seeing that increase in bond prices as yields go down. All right. And but on the bigger picture of bonds, they actually look garbage. Okay. Bonds look hot garbage. Ever since COVID, they're down. What is that, like 40% in the last 5 years? And the time period that they are going up, I mean, guys, look at this. Does this look like a reversal to you? Does this look like the market is screaming, yeah, we're gonna flip this downtrend and start to go upwards? No, this looks like it's just gonna go sideways, 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 and then maybe like a lot lower in the future. Okay, that's what I'm seeing in the market. These buyers aren't convinced that bond prices are gonna go up anymore. They're not convinced, or else we would see a lot bigger candlesticks during this consolidation period. We're not. We're not seeing that. So I believe bond prices are going to go lower, longer in the future. But as of right now, they look to be going sideways. These are housing starts, and the reason we look at housing starts is because they tell us where we are in the real estate cycle. Okay, so from 2000 to 2008, there was 2005, there was that expansionary phase in the real estate market, which coincided into inflation, which coincided into a commodities bull market. Same thing happened in the 1970s. Right now, we are in the same time period as that early 2000s. So let's take a look. Guys, you see this little area right here? This area right here, I believe, is this area right here. Okay. Right now, I believe we're in the early 2000s. In the early 2000s, what happened? Well, it was pretty low housing inventory, a really big bubble, demographics coming into home buying years. Okay. Right now, we're in the AI bubble, no inventory, not low inventory. We have no real estate inventory and massive millennial demographics coming into home buying years. This is going to go up. But what's happening right now, I would like to describe something like this being explained as like a mid-cycle wobble. Okay. Uh, so usually I did have a line. Okay, whatever. But the average occupancy, the average housing starts, it's around in this area over here. Okay, it's like right over here. Whenever it breaks this line, approximately over here, it can be classified as a housing boom market for real estate starts. Uh, this is going to break up to the upside. This is going to break up to the upside because millennials are into home buying years, and they're going to cause the market to respond and such and build more homes. The only reason I believe it's even going down right now is because the only reason we're having this mid-cycle wobble right now is because yields went up too fast and too high in the beginning. So this increase in yields right here kind of distorted the housing market, where unaffordability became a lot bigger issue because the cost of money increased as well. Okay, so that's where we are in the housing market. Now let's take a look at gold. So we had the dollar go up a little bit, yields go down, and gold absolutely started to just breaking those all-time highs, baby. $4,017 an ounce. I mean, guys, just look at this. This is just vertical. Okay, just vertical. I have this chart on logarithmic. So look at the 1970s. Look at this move in the 1970s compared to where we are right now. Okay, during the entire bull market, I would say we're in like the beginning right now. During the entire bull market, it took up that much logarithmic space. If we just put that to the bottom over here, what is that? 2022. I mean, obviously, all right. I'm not saying gold's going to reach $46,000 an ounce, okay? But if we do anything like we did during the 1970s, gold's going to go a lot higher. Just trust and believe, okay? We're in a pattern called a cup and handles pattern. Oh my gosh, silver's having the same pattern, guys. Silver's having the same pattern. It's called a cup and handles pattern. And this is what it looks like. You have the cup, you have a handle, and then you have a big breakout. This line right here is called the neckline. So you have the neckline, cup, handle, massive breakout. Same thing right here. We have the neckline, which is right here. Got the cup. Got the cup. And then got this right here is the handle. Oh my god. Alright. ignore the writing, okay guys. Got the neckline, the cup, the handle, and guys, this breakout's gonna be legendary. You have to be in it. Okay? You just have to be in this, okay? Because once it starts to go up, it may never go down again, okay? Do you think people in the, let's say the 1960s, let's say there were some silver holders in the 1960s, and there weren't any silver holders in the 1960s, okay? The people who didn't invest down here, they never were able to buy in those same prices ever again. Okay, the same thing's happening right now. Once this breaks out, we may never see $30 silver again. That may be stuck in the past. Okay, we may never experience an opportunity to buy an asset as cheap as we could have right now. So right now is the opportunity whenever you're buying some of these assets. Whenever you're buying assets like silver, right now is the opportunity. There is no tomorrow. There is no I should save some money to buy a couple tens of ounces at the same time. That opportunity doesn't exist anymore. Okay? We're already about to break all-time highs. We're already smashing this neckline. We may break out of it. We may do a retest, but then once we do that breakout, it may never be down in this area again, okay? So now's the opportunity to buy as much silver as you can, okay? Platinum. Platinum's looking real good. It's at $1,591 an ounce, $1,591. Uh, and also, I really need you guys to take a notice at some of the use some of your pattern recognition skills and look at some of these charts, okay? All of these started to break out. The beginning of these big breakouts was during the 2000 to 2008 period, okay? Same thing for silver. The beginning of the breakout was 2000 to 2008. It was right here. Same for gold. That's not a coincidence, okay? It's not a coincidence they all started to break out during the same time period. It's because of the housing starts. Okay, and it's because of how those housing starts really started to create inflation in the market. How the housing starts created the monetary inflation in the market. It's because of that mid-cycle wobble we're seeing right now. Okay, that's what caused all of these moves over here. You see? Taking a look at oil. Oil's getting crushed. Oil is not looking very strong, okay? The last trading day, it was down 5.3%. Look at these big red candlesticks. Big red candlesticks right there. This candlestick right here. This one right here. This big red candlestick right here. The latest one we had on Friday. This is bearish, okay? This tells me that the price is probably going to go down in the short-term future. And the reason is because the sellers are overwhelming the buyers. The momentum's going on the downside. All right. Oil's gonna go lower. Okay. I think oil's gonna go lower, and it's gonna give us the best buying opportunity of our lifetime for oil. Okay. And here's why: oil to gold silver ratio. Oil to gold silver. Oil to gold ratio is at the lowest levels it's ever been in history. Okay? The price of oil relative to gold is 0.01. That means oil is 1% of the total price of gold. You would need like around 100 barrels of oil to get you 1 ounce of gold. All right, it's never been cheaper. The only time that this has ever been cheaper was during the not the Great Financial Crisis. It was during COVID, whenever they shut down the economy, which put oil to zero, and then they printed trillions of dollars, raising the price of all of these hard assets like gold, oil, and silver, or not oil, but gold, silver, real estate, and platinum, and the metals. Okay. Never, even during the lowest of the lows during the last bull market, the last couple of bull markets, the 1970s, the early 2000s, how I just showed you how they're all influenced by the real estate cycle. Right now, we're at valuations lower than all of those time periods combined. So, what do? If in the short term, oil is breaking to the downside, but a big macro picture of it says that oil to gold ratio is at all-time lows, what do? What do you do when oil to gold is at all-time low valuations? I'm going to stop here and just pause and just write a little comment down in the comment section what you should do. Okay, I'm going to tell you what you should do. Okay, you should just buy oil, okay? If it's at all-time low valuations, we may never get this opportunity again. Guys, I need you to understand this. Some of us will never get this opportunity again to buy these assets at these dirt cheap valuations. Gold is breaking all-time highs. Gold is going to go up this next decade. Oil to gold ratio is at all-time lows, and we know that all of the commodities that go up together. I'm gonna go back to oil. Remember 2001 to 2008 Look, 2001 to 2001, that was the bottom of the last oil bull market, and I just showed you that based on the housing starts, we're having like the same little fractal as we were during the early 2000s. Like, guys, it's time to wake up. Okay, it's time to wake up. It's time to go ahead, start buying oil, and just buying more, and being more patient. Okay, there's a couple of oil stocks that I'm looking at that went up the last commodity bull market 10, 20, 50x. Okay, uh, just send a comment on down below if you want a couple of my picks, and we'll just have a quick conversation real quick. All right. Next is the S&P 500. The S&P 500 has been breaking all-time highs for quite a while now. Last Friday, Trump he gave out his tariffs talk, and the market, they didn't like that too much. Down 2.7%. Okay, down 2.7%. I'm a little wary of the S&P 500, mostly because, look, the S&P 500, yes, is breaking all-time highs. Yes, this thing is going vertical. Yes, it does look like there's a little bit of weakness right now in the markets. You do the S&P 500 to something that's countercyclical, like gold, tells you a completely different story. Oil is not at all-time highs. It's just the currency's going down. Because if you look at oil, S&P 500 to gold, it looks like it's rolling over. The gold is outperforming the S&P 500, while they're both at all-time highs. And guys, it's not like gold's kind of outperforming the S&P 500. It's putting up massive candlesticks relative to the S&P 500. It's smoking the S&P 500. Okay, so either two things would need to happen for this to go down. Either gold really outperforms the S&P 500, or the S&P 500 crashes and gold stays the same. Either way, the opportunity cost of being into the S&P 500 rather than gold doesn't make too much sense. You're already at really super high valuations. The last time valuations were this high looks like 2000, 2001, during the beginning of the last bull market. What a coincidence. What can I tell you? Now, this is stocks. This is a semiconductor ETF. Big downwards candlestick, down 6.27%. Guys, I've been doing a little bit of research on Nvidia and how some of these semiconductors have been making their money. Okay, and what I have to say is I'm not very pleased. It seems to. I want to make sure I word this correctly. It seems to be that they're making a round trip investments in for some of their companies. Okay, I'll give you an example. Nvidia invests into OpenAI, which OpenAI then uses that to buy Nvidia chips to train their AIs. Okay, it's kind of a conflict of interest whenever you're investing into a company, particularly for them to literally just go ahead and buy your equipment and then counting those equipment sales as sales. It's a little shady. Okay, I don't know. I'm not gonna say too much about it right now, but it seems to be a little bit of shadiness in the AI market, kind of similar to the 2000 2001 tech bubble. Uh, anyways, today it's down 6.27%, big red candlestick. There's a lot of momentum on the upside though. I'm going to be looking at semiconductor stocks really closely these next couple of weeks, okay? Because if we see another sharp downtrend like we did during 2022, uh, things are going to get a little ugly, all right? Bitcoin's actually looking not too bad. The Bitcoin community and the crypto community, they got absolutely wiped out these last couple of weeks because of this downwards move right here. Bitcoin, I think it went down like 7. What was it? It went down. Oh gosh, yeah, it went down 7% in one day. A lot of the altcoin investors got absolutely blown up. A lot of pain in the crypto markets. Bitcoin still looks pretty good. Now, would I be invested into Bitcoin at $114,000? No, no, you don't. No, okay. Bitcoin's already at a $2.2 trillion valuation. Okay. if you want to make a 5x in crypto, if you want to make $1,000 turn into $5,000 in crypto, the market cap's going to have to be over $10 trillion. I don't see that happening. I don't. But Bitcoin looks good though. Ethereum also looks super good. Up 10% for today. Today's Saturday, October 12th. It's up 10%. On Friday, it was down 12%. So down 12%, up 10%. I mean, that's just the crypto market for you. Super volatile. Has a lot of upwards momentum on it. I think this is going to go higher. The dry bulk index, one of my favorite indexes. So the dry bulk index, it's a marine transportation for commodities. All right, they transport commodities from, let's say North America to China. I mean, we don't really trade with China, but let's say freaking North America to Europe. Okay, or from Europe to North America. They transport commodities via marine transportation, and it looks like. Look, higher lows and then higher highs, but then the higher highs turn into lower lows, or higher lows. So we're having higher lows, lower highs, squeezing it into a wedge. This would be a falling wedge, and the falling wedge kind of looks something like this, where this move right here is this short period from 2022 lowers, and everything's pointing for dry bulk shipping stocks to do a lot better than what they are right now. Okay. M2 money supply. We're printing more money, baby. Print. Okay, guys, money doesn't fall from trees. It's printed into existence. Okay, this is planet finance. You must know this. Okay, money doesn't fall from trees. It's printed into existence. And we printed $80 billion of currency last month. Okay. Alongside the federal government's balance sheet, it increased by $450 billion in 1 month. Guys, the federal government's balance sheet increased by $450 billion in 1 month. And you're telling me like everything's kumbaya, everything's just going perfectly fine in the market right now. At the same time that $450 billion is increased in the Fed's balance sheet, and the entire market falls off except for bonds, which they don't do too good. Okay, because yields were down 2%, but bonds were only up 1.61%. That means that people, they kind of saw the fear of the market, and they still didn't even like bonds. Okay, so even when bonds would conventionally be in the best position to go up, they still didn't even do that well. But gold and silver are freaking breaking all-time highs. I mean, gold's already smacking all-time highs, but silver seems to be on the precipice of is breaking its all-time highs. It's breaking 200-year patterns. You think this is all a coincidence? No. What seems to be going on is it seems to be that the central bank is buying our treasuries bonds, okay? And since bond prices and yields are inversely correlated, the central bank buying the treasuries bonds makes yields go lower, which means the debt becomes cheaper. And this really matters because the interest payments on the government's debt is going vertical, okay? You look at the federal government's interest payments on their debt, it's $1.61 trillion, okay? $1.61 trillion. They need yields to go lower, or else the interest payments on their debt is going to continue to go vertical, okay? Guys, this isn't the debt. This is the interest payments on the debt. They need yields to go lower, or else the government's just going to go bankrupt. They're not going to be able to fiscally support the interest payments on the debt without printing more money or buying their own bonds. We're going to have inflation. It's inevitable, okay? This is why the inflation is inevitable. Because when you have $1.16 trillion in interest payments, okay, you need to lower the price of currency, or else you end up defaulting on your debt. All right, and then the bond market explodes. Or you can slowly sacrifice the currency to pay off some things like this, the interest payments on the debt. But then what you do get is devastating inflation and a cost of living crisis. Cost of living crisis. Um, so yeah, it looks like the government's buying up our own government bonds to lower yields, to cheapen money a little bit, so our interest payments on our debt and other set expenses can become a lot more affordable. And the implications of this is that we're going to have a lot higher inflation. Our currency is going to become weaker, and gold and silver and the physical commodities are going to take off like they have never before. But hey, thank you for watching. Drop a comment, any of your thought ideas. Maybe you disagree with me. I love for you to just write a comment to tell me what you think about the markets. Maybe you do agree with me. Tell me a little bit on how your idea of what's going on is a little bit different from mine. Just an open conversation here at Daley and Paulk. Uh, and yeah, I really appreciate you watching. Just a thumbs up, like, comment, subscribe, and I'll see you guys later.